The impact of the Silicon Valley bank collapse on the EU's banking sector is limited. That's according to the bloc's financial services chief. Speaking before the European Parliament in Strasbourg on Wednesday, Mairead McGuinness used Silicon Valley Bank as an example of why lightly regulated foreign lenders need to meet stricter rules inside the EU.
Thank you, President. Good afternoon. These US banks were not subject to strict regulatory requirements for liquidity because the United States does not apply Basel to mid-sized and smaller banks, while here in the European Union we do apply the Basel prudential standards to all banks. Had this been the case in the US and the Basel requirements on liquidity applied, it is likely these US banks would have had a stronger liquidity position.
The Basel regulations are designed to decrease the damage done to the economy by banks that take on too much risk. The European Commission says it's monitoring developments closely. One Dutch MEP, though, says the European banking sector is well equipped to weather a Silicon Valley bank-like storm.
I am confident, however, that we have learned from the previous crisis. We've had a huge banking crisis in the European Union. We have built a new framework when it comes to banking legislation to avoid these crises in the future. And now we will see in practice whether what we have done in the past years is sufficient to prevent such a crisis from spreading to Europe. And I'm confident that this will happen.
Fallout from the collapse of Silicon Valley Bank isn't completely contained, though. Investment bank Credit Suisse has been hard hit, a much bigger concern for the global economy than the regional US bank. Shares of the Swiss banking giant plunged 30% to an all-time low, after its major shareholder Saudi National Bank said it wouldn't buy more shares in the Swiss bank on regulatory grounds.